Good afternoon, everyone. Welcome to another business health workshop. This is number 3 of the year. Previous 2 have been in previous months, and if you can find those on our YouTube site, this one's about knowing your numbers. So welcome, everyone. Just a bit of housekeeping. Just bear with me. So first thing is that the webinar's on GoToWebinar. So there's a couple of bits. The orange little tag on the side of your screen will open the control panel. From there, you can open and close it, but you've also got all your audio features. You're obviously muted, so nobody can see or hear you. You can just hear me. And there's also a handout section where you can basically grab the handouts for today, which is a fairly detailed insider report about your accounts, goes in a bit more detail, and also the slides as well. Other housekeeping point is just a brief apology. I'm still suffering slightly from sore throat from last week's second COVID vaccination. So if I go quiet for a couple of seconds, I'm just grabbing a bit of drink just to keep the voice lubricated. Okay, thoughts for today is something you've probably heard before. What you can measure, you can manage, and that's from McKinsey, which is one of the world's leading management consultants. And I suppose by inference from that, you can get that what you don't measure isn't being managed. So today we'll go through that as a sort of overview. So agenda for today, we're going to go through the basics, why you need to know your numbers. That may seem fairly obvious, but there are a few areas of what can be done with numbers that may not be immediately that obvious. We're also going to go through why accounts are useless. That's annual accounts. We'll go through some of the pitfalls because that's not the be all and end all of knowing your numbers. We'll then go through the key pages in accounts, whether that's annual or monthly, the bits of your annual accounts that are actually useful. We'll go through the difference between profit and cash because that's often an area that people get confused about. That's quite a big area, so that's the key bit today. Then we'll go through very briefly some things you can do to protect your assets, and then how you can adopt best practice with your numbers and running your business. And then we'll just go through the normal bits at the end, which is next steps, how we can help you, and any questions. In the bottom of the control panel, there is the ability to ask questions. So if nothing makes sense or you've got any queries, general queries about what we're going through, then just type in some questions. And if we get time at the end, we'll go through those. If we don't, then I'll come back to you individually with those answers. Typically, I don't use typed scripts for these, as you probably can gather already, which means that the timing isn't exact. Often it will be overrunning, not underrunning, but I'll try and keep to the time frame. But we've got roughly an hour and then 15 minutes for Q&A, but I suspect it'll probably be slightly over an hour because there's a lot to get through. Okay, first bit then is why you need to know your numbers. We're going to go through the numbers that you look at and things that you ought to get from those, but in a practical way. And it covers the basics because I don't know your individual knowledge. So I'll cover basics initially, which you might go, well, this is teaching me how to suck eggs, but we will then get on to stuff that is a little bit more detailed about how you can use that. But I'm hoping that even within the basics, there'll be some stuff that will come as a bit of a bolt out of the blue for you. So main reasons are the numbers tell the story of your business. And I think that is a key part of business planning. And I use analogies when I talk about business plannings and business journeys. The one I often use, and apologies if this isn't your key sport, is football. Is what happens with, particularly with annual accounts, is that they get presented 12 months at the end of the year. They're often going to be a lot later than that. And that's really a bit like a football manager looking at the scoreboard at the end of 90 minutes, the end of the game, and going, how did we do? And the answer is it will tell you, but the reality is you can't then change that match or the result. Whereas what most football managers do at the top end is they're obviously planning. So they actually have a plan before the game. They know exactly how they see it going. They then basically see whether the actual game is going how they planned it, because it often won't, because there's another side that gets involved. And then they tweak it. So they change what goes on in that game to try and get the end results they want. And it's exactly the same in running a business. So you shouldn't be waiting for the annual accounts that you may not even fully understand to tell you how things have gone. You should have a plan. You should have an aim for a period of time, and then your numbers need to tell you whether you're on track. And if you're not, then you've got plenty of time to basically look at those numbers and work out what you can change. Second thing is early warning signs. So your numbers will be able to, if you know what to look for, they'll be able to predict where issues can arise. It always surprises me that a few businesses, quite a few businesses, even before COVID, would get to crises within the business and they were operating at the 11th hour. So they couldn't see that coming because they weren't investigating the numbers to see how things were going and what particular numbers they needed to look at. So early warning signs are there if you know where to look. It will also tell you areas of strength and weakness. So obviously the areas of weakness are the ones to address because they're the ones that will stop you getting your goals. But also the areas of weakness can sometimes be the areas that business owners don't like doing. And that's why the other areas are successful, is because they know how to do that and they do it more regularly because they like doing it. So it will highlight areas where you may need to get involved or get somebody involved to help the business that might not be your comfort zone. It will support better decision making, and that's one of the key areas, is you can plan forward and decide to do things, whether that's basically taking on staff, opening new branches, expanding into new products or service lines, or reducing or exiting or borrowing. Any of those things need to be decided on with the numbers helping you make that decision. Often it's a knee-jerk reaction, and that's why a lot of those decisions don't pan out. And lastly, but not leastly, especially post-COVID, is to understand how third parties will view those figures. So how will a bank look at those figures? How will a lender look at those figures? How will a business buyer look at those figures? Because again, we're often surprised at how confused business owners are when lenders and bank managers look at the accounts and come to a completely different conclusion as to how that business is doing. And that's because they're looking at it from a different point of view, and they're looking at certain numbers that probably the business owner doesn't understand or doesn't look at. So all of those reasons and much more are why we should be looking at the numbers. Okay, this may seem a bit strange coming from an accountant. For those of you who aren't clients, I'm Mark Lawson and I run Business Vision Accountants. The prime aim is to help businesses grow profit and cash flow and have a bit more spare time to do that. So it would seem strange that, as that's a big part of my business, that I would call them useless. I'm largely talking about end of year figures, and I'll tell you why. There are lots of reasons why they aren't particularly great. The first one is timing, and that's sometimes down to the accountant, sometimes down to the business owner, but inevitably the accounts are done for 12 months, and there's no logical reason why that period of time is in any way sensible for a business. That period of time is simply how long it takes the Earth to orbit the sun. So there's no logical reason or scientific reason why that's the correct period for business owners to be looking at their numbers. There is a lot of facts and scientific reason as to why that's too long, and I suggest it should be monthly for pretty much every business, and maybe even more regularly for larger businesses or businesses with issues. And often those 12 months accounts are then not done by the accountant for 6 or, God forbid, 9 months after the year end. So by that stage, they're history. You know, things move quickly these days. So accounts that relate to 21 months ago just aren't going to be of any use, and they're not going to be of much interest to the business owner. So we do get annual accounts out within a couple of months of year end where possible, but even that still means you're looking at, 14 months old to 2 months old. So regular monthly figures, and when I talk about numbers a bit later, I am talking about numbers that you can get from your day-to-day bookkeeping system, not having annual accounts. Second reason they're useless is they're not designed for small businesses. Accounts and all the legislation that goes with what goes into them, which we have to follow as accountants, is related to generally companies on the stock market. So they're not intended to be of any practical use to you. They're intended to be of use to basically share buyers and people who look at stock market to make financial decisions. And they're actually geared to stop those businesses inflating profits to make the share price go up. Whereas small business end, it's usually the other way around. We want to deflate profits to make the tax figure lower. So the layout and the pages and pages of notes you get are not intended to be of practical use to you, but the accountant can't change that. By law, they have to be there, and a lot of useful stuff doesn't need to be there. So reading through the notes isn't going to add a lot of knowledge to you. Fourth thing is they only deal with pound signs. So accounts are all about money, and obviously running a business isn't just about money. There are things like the business owner's happy score. So out of 10, how happy are they running the business? How many hours do they work? What's the staff morale? Well, those are all things that are crucial to a business, but you're not going to find that in the accounts. The other key thing, which I think is one of the key things you should note down in your notes today, is that limited company accounts deal with directors and shareholders as two different entities. And that's because when you're talking about stock markets, they are. The directors run the business, the shareholders invest money and get paid dividends from time to time if the business is profitable. So there are two areas in the accounts, and we'll go through where those are, where they're relevant for large businesses, but for you, they really need combining, because you are most often, I'm presuming most people on the webinar are actually owner-managed businesses, so they run the business and they own it. So directors and shareholders is a meaningless differentiation. Add them together and we'll show you where that would cause problems and how you deal with that. Next one is obviously they appear complicated. We'll go through the accounts in a moment. They're by no means, I think, as complicated as people think, but that's usually because they've never been explained. When we take on new clients, I'm again staggered that they've been running a business for 20 years, still don't understand the accounts because they've never had the figures explained to them, but they're expected to sign off those accounts and pay a large amount of money for them. So complicated, but hopefully by the end of today, not as complicated as you might think. And weirdly, for small businesses, there's no need for a cash flow statement, which is, in my view, one of the key areas that you ought to be getting figures, because that's obviously going to define liquidity and whether the business can survive. So you can get cash flow statements done, but they're not automatically produced in the accounts. So I think, and again, this isn't attendees today, it's a generalization, but business owners, in my view, if they look at stuff, they always look at two things and often not much more, and that's the sales figure and the bank balance. And the reality is neither of those two figures are particularly useful in terms of running a business. Sales, because sales doesn't guarantee success in any shape or form. We all know businesses that have gone bust that are far bigger than our businesses. Carillion, British Home Stores, you know, Woolworths, all of those, they had millions of pounds worth of turnover and still managed to go under. So large sales is not a guarantee of success. Weirdly, it can often be a trigger of failure, especially if you don't follow the numbers. And also we've had situations where we're looking at the bank balance, and then, you know, we've had clients where they suddenly go out and buy a new car, or they go on a big holiday, and then 3 weeks later, lots of things happen. The VAT bill comes in, an unexpected tax bill comes in because the accounts were done late. That's not us, but other accountants, and other things go on. You know, maybe there's a surprise bill coming from a supplier, and suddenly that money shouldn't have been spent because they were looking at the bank balance. They weren't looking at what's coming up in the future. So that's a number of things, but we're going to make sense of accounts. And as I say, I think if you actually delve into the accounts, and this can be done, as I say, monthly or weekly, you can get enough information, and then the end of your account is really just a signing off exercise. So let's go through financial accounts. Start with the easy one, which hopefully most people will be vaguely aware of, which is the only one people usually look at when they get the accounts, is the profit and loss. So I've just highlighted the key areas. And I'm hoping these will be fairly straightforward, and they're in the order. They're usually in your profit and loss account. So we've got sales at the top, less direct costs. So direct costs should be things that are costing because they're directly related to what you're selling. And that's often going to be productive labour or materials or products. So it's really material stock and direct labour. It's the things that you have to get the sales. And if there are no sales, you don't have to have those costs usually. And the difference between those is called gross profit. That's quite an important figure we'll come on to. Then off gross profit comes expenses, overheads, and that gives you your net profit. There are weirdly lots of different names for net profit, which are different types of profit which leave out or include certain things. I won't go into those. This is the net profit that will appear at the bottom of your profit and loss account. Overheads could be another name for expenses, but overheads shouldn't include anything directly related to sales. It shouldn't include productive labour. It should include admin and sales and marketing labour. And again, we find in some accounts produced by other accountants that doesn't happen, which means you get distorted figures, which means you can't make sensible business decisions. And it's worth pointing out that net profit at the bottom, that's basically a mathematical figure. Because it comes after an equal sign, it's just the difference between two figures. It's basically sales less costs. So you can't directly influence net profit. It's just a mathematical formula. What you can influence is the income and the expenditure. We then move on to the sort of next page of profit and loss, which you won't see easily within your accounts because it's sort of hidden in the notes. But off net profit comes tax, which is the tax for that period. Won't be due yet. We'll come on to that. Less dividends, and that equals what's called retained profit, which is another important figure. That's basically what's left after all the third parties have been paid off. So off profit, net profit is what you make. Then the third parties get their wedge, which is the tax man. And for big businesses, the shareholders want a dividend paid out. Now, my view is that dividends in small companies are a tax planning strategy and nothing more. They're paid to you because you're director and shareholder. They're not a reward to a third party for investing in the company. And therefore, that ought to be treated as director's salary or director's wages, even though it won't be in the accounts as such because it can't legally be shown, but mentally or actually in a separate set of figures, that's where you should adjust it. And the reason for that is you could be looking at net profit and go, wow, we've had a great year. You know, we've made £120,000 net profit. But the reality is, if after that comes 30 grand's worth of tax and 100 grand's worth of dividends, which is really director's salary, then there's no profit there at all. So we need to basically mentally or physically, preferably, include dividends to the business owners as if they were wages. And I'll come on to a fine tuning of that comment, but just to get that thought in your heads, is dividends in accounts don't appear in your profit and loss account. They appear afterwards. Therefore, when you look at net profit, you're not seeing the true picture most of the time if those dividends are really wages. And for small businesses, that's usually the case. Great tax planning strategy, but it does distort the figures. So a few thoughts on profit and loss. There's not a lot of things to go through here. I think most people know roughly what profit is, but we'll go through a few areas where there is some confusion. First thing is that, particularly when accountants and bookkeepers get involved, there's what's called date matching. So everything has to be assigned to the right accounting period. And an example of that would be, let's say in month 12 of your yearly accounts, you pay £1,200 for an annual insurance premium. The reality is that that hasn't affected your profit by £1,200. It will look like it in your bookkeeping software probably because you've put the bill in or you've made the payment and that goes through. But the reality is that insurance covers 12 months, of which only one is in that accounting period. So the accountant will take the other 11 months and push them into the next period. And if you're doing monthly figures, they'll push them equally into the next 11 months so that you're matching up that insurance properly. Otherwise, when you look at your profit and loss account for the month 12, you're going to see that there's a huge increase in overheads, but it's not real. You could cancel that insurance after month 1 and get 11 months refunded. So you only lose profit on stuff that goes over a long period as it accrues. And we call that prepayments. You've paid something in advance of the accounting period, or part of it is. And another example of that would be the reverse, which we call accruals, where you might have actually incurred a loss in the year for, let's say, electricity, but the bill doesn't arrive to month 1 of the next accounting period. So we bring that back because you've used the electricity in that year, you just haven't had the bill yet and it hasn't gone through your bookkeeping. So prepayments and accruals are simply moving stuff around to get them to match up as accurately as possible to give you an accurate profit in your accounts. Another example of us doing that would be work in progress and stock. So the whole point of putting a stock figure is to move the stuff that hasn't been used into next year, where it will be matched up with the sales. So it doesn't mean that you've lost a lot of money if you simply get a £100,000 stock bill in month 12, because you may not have used much of that up. It will be there to sell in the forthcoming year, so we move it forward. And the same with work in progress. You may have had employees working on a job in this year, but you're not going to bill it till next year. So we push that cost forward to match it up with the sales invoice, which gives you accurate profit. And for that reason, if you're trying to do what I call clever tax planning and you go, oh, let's not send our sales invoices out until next year, we'll save tax. Theoretically, you don't, because the accountant's just going to basically push all the costs forward as well. And that gives you accurate figures. Next thing is, we've mentioned dividends are wages, so we need to adjust that accordingly, even if it's only mentally. But I would fine tune that, because dividends are not a true reflection of the director's costs. They're a reflection of what the director wants to draw out, which is not the same thing. Often what they draw out can be lower or higher than the true worth. So I would replace wages to the directors and dividends to the directors with a notional figure, which is basically, what are they worth? What would it cost to get someone to do that work as a real salary if the director didn't do it? And that's a difficult figure to come up with, but I wouldn't underestimate that. And the reason for that is because, let's say you get a set of accounts and they show 100 grand profit, and then there's £20,000 tax, so you've made £80,000 tax, but the dividends are only 20,000. Because the owners don't need the money and there's not enough cash to pay them, so they've effectively left it in. But to see whether your profit's any good, you need to make a notional adjustment. Otherwise, you could be making a profit, and the reality is, if it's 30 grand profit and you're worth 40, it means you'd be better off stopping your business and going and getting that job that pays you 40. So coming up with a figure isn't easy, because you're obviously doing lots of different tasks and functions, but if in doubt, I'd go higher, because the whole point of being in business is your profit should be a lot more than you could earn in a real job. And part of that calculation should take into account your hours. So I've often had conversations with business owners where I say, well, what's the real value of your wages? Because you've only put £8,000 through your accounts. And they go, well, actually, you know, when I used to work in a job before, I got paid 30. And I go, well, how many hours do you work now? And they go, well, 70. And how many hours did you work then? Oh, 30. How many weeks holiday did you get then? 6. How many do you have now? 1. So the reality is that person's got 2 jobs. And that means that the value should be at least 2 lots of 30. But I would argue even more, because they're running a business which they weren't before. So they're now being a managing director some of the time, and that obviously is valuable. So make a notional adjustment, and we often will go through that with clients. Otherwise, you'll get a distorted net profit, and you'll be thinking you're making money, but the reality is you're just working for less money than somebody with a job, and often your employees that are making. Depreciation, I mentioned briefly. Depreciation will appear in your profit and loss. Nobody really knows what it is. It's an accountant's estimate of what is being lost in value on your long-term assets. So things like cars, vans, equipment. Obviously, they get bought, say, for 10,000, but gradually they'll lose money as they become older and older. And this is just an estimate, so it's never going to be accurate, because it's a percentage and it applies to all categories. So we'll depreciate every vehicle by 25% a year, but obviously some of those vehicles could be doing 200,000 miles a year, some of them might be doing 5,000. So it's an estimate, nothing more, and you need to know that. And the idea is that depreciation isn't really money being spent. So even if you spend all your profit, you should still have that depreciation left in your bank, because that was shown as a cost but isn't really, and that would allow you to have money to replace them. So that's the theory for bigger businesses. But it's important to realise that those assets are losing value, which is obviously coming off your profit. If you buy a car today for 10,000 and end of this year it's worth 5, you've lost £5,000 worth of profit and value. And the last one, why profit and losses are a bit dangerous to look at in isolation, is on their own they're completely useless to assess a business. I cannot assess a business, you cannot assess a business purely by looking at profit and loss. And I'll explain why. If I had two sets of profit and losses that looked identical, and let's say they showed £100,000 profit, you might think that's okay. But if we then look in other areas of the business, we can see that the business owner is taking out £200,000 to support a very large mortgage and maintenance and 6 stepchildren. We can see that one business basically gets paid after 120 days by their customers, the other business gets paid immediately. We can see that one person has debts of £1 million, the other business had none. So none of that will appear in your profit and loss account, but it's obviously crucial that you know that that is there. So profit and loss won't tell you those things. It won't tell you what the business owner's drawing out as dividends. It won't tell you whether they're taking out loans, so there's no cash. It won't tell you how quickly money's coming in. It will tell you what you've made as profit. It won't tell you where that is. So you need other statements to go along with that. Profit and loss is there, but actually if you look at that in isolation, you can't tell a thing about the business. So really, profit and loss just says, how did we do? Did we have a good day? Did we have a good year? And that's the end of it. Once that's done, it all starts over again. So key numbers for each of the items in the accounts, we'll go through the key numbers. I think profit and loss ones are fairly straightforward, hopefully for you. Gross profit, that's the money you make on buying and selling whatever it is you buy and sell. Couple of issues with that is that in an ideal world, you need to know what we call indirect costs, which are things that do go up and down with sales, but they aren't always treated by accountants as pre-gross profit. So they're not coming off to get the gross profit. And I'm talking about things like maybe bank charges, maybe telephone, those sort of things. As you double your sales, those things might double as well. So just be aware that in your overheads, there might still be things that go up and down with sales. They aren't fixed, like some of the other costs, rent and rates, for example. So gross profit, probably more importantly than gross profit, is the percentage. That's obtained by dividing gross profit into your sales. So it's what percentage of your sales do you keep after direct costs and labour. And that's important because if your gross profit goes up a bit because your sales have gone up a bit, that's fairly obvious, but you need to know whether it's gone up proportionately, and the gross profit percentage will tell you that. And that's a measurement of bang for buck. So for every sales, what bit do we keep? And the idea is to keep as much as possible. It's a measure of quality profit, not quantity. Sales is a measure of quantity. So gross profit percentage, that should always be a figure you get from your accounts, and you obviously want to do a couple of things with it. You want to see how that is compared to previous periods for you, and you also need to see how it is compared to your competitors and your industry, because you may well be under the industry average, which means something's going wrong. Other thing to mention with gross profit is that the two key ways, there are actually hundreds of minute ways, but the two key ways of improving gross profit is either to increase your sales or to increase price. Efficiency comes into it as well, but it's far better to improve price and efficiency, because more sales gives you more costs, more effort, and probably more time in the business, whereas efficiency and price gets you more profit for doing nothing other than the exercise to improve them. So if you put your prices up 10% and you don't lose any customers, you're going to be making more profit, but still doing the same level of work, still doing the same jobs, the same deliveries. And we can go through that in a lot more detail. There's previous webinars we've done that go into that in a lot more detail. I think the first one this year went into pricing. And also sales growth is a lot harder than efficiency and pricing strategy because everybody's looking for more sales. The good news is nobody's particularly in competition with you and looking very hard at pricing and efficiency. So sales growth is a measurement. Even though I've said you can go bust with sales, we do need to know how much sales are growing. That's nice to know, but it's also a good indicator of whether growth is going to be a problem. Profit after owners wage adjustment, that's what we've just talked about. So you need to know what is not the profit in the accounts, but the profit after your real wage adjustment. What's that? Profit percentage, so net profit percentage, so that's the bottom figure as a percentage of your sales. So that's after everything, what percentage of your sales do you get to keep before the tax man? And an ideal percentage there would be between 10 and 20, but that's after owner's wage adjustment. You could easily be getting 20% before owner's wage because you might only be taking out 8 grand and working 80 hours. So 10 to 20% is a good benchmark. Gross profit percentage, it's hard to say what should be the real figure because it depends on the industry. But net profit, I would say 10 to 20 after all the owner's wage adjustments. And then retained profit, really that just needs to be positive. There needs to be money left in the business. But there is a slight issue with that, which is that if you leave money in a business, that's really just the owners not taking it out. And obviously if the owners take it out, they pay tax on it, so it often gets left in. But it's really a tax bill waiting to happen. There is an argument that says small businesses should try and take out as much as they can tax efficiently, but certainly with COVID, there's an argument that you need to have your business looking good. And there's a problem because those two are mutually exclusive. You can't take all the money out for yourself and effectively not have a future tax bill without and have a good looking business. You have to leave retained profits. So the conversation I think is always, where's the happy medium? How much can we leave in to make the business look good, and can we have the rest? And that's a conversation with accountants, to be honest. And the last one, which you may have heard bandied around, is called EBITDA. All that means is earnings, which really means profit before interest, tax, depreciation and amortization. Amortization is similar to depreciation, and it's really saying what's the profit before all these fancy accountancy adjustments and third parties get their wedge, your lenders and the taxman. And that's useful because firstly, it's used by buyers of businesses. Most business buyers will buy some form of multiple of EBITDA. So it's very useful for that. But there's also other areas where that figure can be quite handy because it tells you what it is you've actually created before other people do things that you can't really control. So profit and cash, you've probably heard this: turnover is vanity, profit is sanity, and cash flow is reality. So as I say, turnover and growth of turnover is great, but it's not in any way, shape or form guaranteed to get success. Profit is sanity, but cash flow is actually more important. It's quite common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. We often get people going, I can't have made that much money, where is it? And it's up to the accountant to explain, but it's very rare it's all going to be in the bank. It's going to be in other areas, and those other areas will be dictated by the balance sheet. So that's profit and loss. Hopefully that's all fairly familiar to most of you. Cash flow statement, as I say, you won't get that automatically in your accounts because you're not large enough, but it's effectively very straightforward. It's money at the beginning of the period that's in your cash and bank, plus money you've had in during the period, less what you've spent out, equals what you should have at the end. And that's all it is. It's not a forecast, it's a statement of what's happened. So it's really like a clever bank statement, but all combined. And the key number there really is that money retained at the end enough? Is it enough cash at the end to do what you need to do? If not, what's going in and out, and what can we adjust on that? And is that bank balance growing? So one of the things we do with clients is we have software that will produce that sort of information, which goes through the top figure is money in, that's your sales. Then it sort of goes down and go, well, this is the money that's been sent on direct costs, so labour, materials. Then we've got your expenses and we get to profit. But it then carries on down, and that screenshot goes down a bit further to say, well, actually, to see how your closing bank balance was arrived at, these are all the other things that have happened. So yes, you've had to pay tax. You've also had some changes in people owing you money. So last year they owed you 10,000. This year they owe you 30. So actually that means you've got £20,000 more that hasn't yet hit the bank. So although it's in your profit, it's not in the bank. And we can explain all that, and we gradually go down, and all those pluses and minuses will then get us to the bank balance at the end. So it's quite an easy one to follow, but it explains what happens after the profit and loss account to show why that didn't hit our bank account in total. And most of the time, it's usually what hits the bank account is lower than profit, not always. So just to explain a little bit about the difference between profit and cash, I'll go through this. It's not essential you understand it, but I think it's an easy way to just understand the interaction. So I've got a dummy business, which is a car garage. They buy and sell cars, and I've got two columns that are profit and cash. So we're showing, once events happen, what is impacting the profit and loss account and what is impacting the bank. So the first thing that happens is very simple transaction. The business owner goes out and he orders a car to sell, but he gets 30 days credit. Now, a lot of people would go, oh, that's going to affect the profit. The reality is it doesn't. So there is no change in profit or cash there. There's no change in cash because he's got it on credit. There's no change in profit because he hasn't lost any money. What he's basically got is a car that's worth 10,000, but he's also got a liability that's worth 10,000. So there's no gain there. And what you'll see in the accounts is that if that car is still there at the end of the year, it's carried forward to match up with the sale next year. So that first item, no effect on profit or cash. Next transaction is that the car was sold on 14-day credit. So somebody comes along and buys the car, and the owner gives them 14 days just to test drive it before they end up deciding and buying it. Well, obviously there's still no change in cash because he hasn't paid anything out yet and he hasn't had anything in from the customer. There is a profit. There's a paper profit because he's now sold that car on paper for 14,000. The stock he had was 10,000, the cost of the car, so he's now made 4,000, and that will be in his profit and loss account even though nothing's actually gone through the bank yet. It's based on paper and it's based on time, and the time is the date that the sale was made. So now he's got £4,000 profit, no cash, which is what you'll often see in a business. Next thing that happens is basically the customer pays. So 14 days runs out, customer pays. Obviously, there's no change in profit there. All that's happened is the customer owed him money and he's now giving him the cash. So the business owner swapped a debt for actual real cash. No change in profit, but there is obviously £14,000 now going into the bank. Next stage is the business owner then pays the supplier. So the 10,000 that he owed for the car, he now pays. Again, no effect on profit. He's just basically paying a bill, and that comes out of his bank. So basically, he's now got £4,000 in the bank and £4,000 profit. So eventually, once everything's done and dusted, cash flow will equal profit. But the reality is that is only usually the case at the very beginning and the very end of a business. Year to year, there will always be discrepancies. And the one thing that I've sort of missed out there is there is obviously going to be tax on that. And what you'll find in accounts is that tax is usually put in at the end of the year by the accountant. So when you're looking at your profit, you need to be aware that nobody's provided for the tax. It's a sensible thing to provide for tax on a monthly basis, but I don't see it being done very often. And obviously one of the things we do when we do accounts, because those figures will change, we'll be putting the tax figure in, we'll be putting depreciation figures in, we'll be basically doing all the prepayments and accruals we talk about. So one of the things we check is what does the business owner's profit look like when we get the books, and what does it look like when we give them back? Because if there's a big difference, it means the real profit is actually substantially different than what the client's looking at. And that may mean that there, depending on the business, that some tweaking needs to be done to get some of those adjustments done during the year, not just at the end. So that's profit and cash flow. So the last one is the dreaded balance sheet, which again, in my experience, is very rarely looked at by business owners because they don't understand it. So we'll try and make some sense of that. So this is the layout you'll see in the accounts. They may have different names, so I'll try and give you some of them. Fixed assets, long-term assets, they're basically things like cars, computers, property. They're called fixed assets or long-term assets because they're supposed to be things that are likely to remain in the business for more than 12 months. Doesn't mean they have to, but generally that's what would happen. A van would normally be there for more than a year. A building would normally be there for more than a year. So these are things that are going to be around typically for more than 12 months. Then you've got current assets, and they're things that aren't going to be around for 12 months. They will be converted into cash. So that will be things like stock, work in progress, money owing from customers, all those sort of things. Within 12 months, they should hit the bank. And they're called current assets or short-term assets. And that's the layout you'll get in your accounts. They might have slightly different headings. That's how it should be laid out in formal accounts. And I think the best way to look at a balance sheet is to try and replace it with personal situations, because it's exactly the same and it's easier to understand when it's personal. So basically under fixed assets would be your home, would be your car, would be a fridge. They're all going to be longer term assets, but they're positive things. They're things you own. Current assets are the same. That's going to be obviously bank, which is already cash, but it's going to be, maybe you've lent somebody 500 quid. That's an asset because they're going to pay you back. So that's going to be money in the bank at some point. So all of those things are assets and they're positives, things you own. Then we've got liabilities, or some accountants call it creditors, and that's broken down similarly. We've got current liabilities. They're things that are likely to have to be paid within 12 months. So that's generally going to be things like your suppliers, the VAT man, the tax man, etc., etc. It also includes bank overdrafts, because bank overdrafts are repayable on demand. So accountants would typically include that as short term. And for home, the equivalent of that is usually like your credit card bill or your Lecky bill, that sort of stuff. It's a liability. It's money you're going to have to spend at some point. But current means you're going to have to spend it within 12 months, typically. Long-term liabilities is liabilities, but they won't have to be paid typically for over 12 months. And I'll show you in a minute why that 12-month is fairly crucial. So long-term liabilities in a business would be loans, although good accountants will split the loan into the bit that's got to be paid within 12 months and put that in current liabilities, and the bit that's going to be paid after 1 month, a year, and put that in long-term. A lot of accounts we see just have it in one or the other, but it's actually a bit of both. So businesses would have loans that are over 12 months. They might have HP agreements that are over 12 months. They could have loans from family that aren't going to get repaid back within 12 months, etc. And then the difference between assets and liabilities is what we call equity and reserves. And that's quite important. We'll go through that in a moment. So that's the typical layout, but I don't like that layout because it doesn't allow me to explain it properly. So I'm going to move it around so that it's basically side by side. Okay, so what you've now got is those presented as the positives on the left-hand side and effectively the negatives on the left-hand side. Now, that may make perfect sense, but how does equity fit into it? Well, equity is basically what you've put in as a shareholder, so your share capital, plus all the profits since day one. So what happens with your profit and loss account at the end of the year? Accountant tops up how you've done, they close it down and they push that into the balance sheet. And if you do that monthly, the same thing happens. So that's really all the profit you've made after tax, after dividends, after everything. It's the retained profit since day one. And it's really, if you think about it, it's on the right hand side because it's still money owing. It's money owing to the shareholders. That's what they will get when the business is wound up. So if you look at your accounts balance sheet, within a couple of reasons which I'll come on to, if you take the assets and deduct the liabilities, what's left is what's going to get paid to you as a shareholder when the business is wound up. So it's still money owing, but it's effectively money owing to you as a shareholder, which is why I say directors and shareholders should be treated the same. The important thing to realise on that, though, is basically that those two sides are going to total the same figure. So if you add up fixed assets and current assets, the figure you get will be the same as adding up the three on the right. And that's basically always going to be the case. It's why it's called a balance sheet. And that is happening because of what we call double entry bookkeeping, which I won't go into, you'll be pleased to know. That was invented by the Romans around 70 AD. And that basically says that in a set of accounts, if something happens that's a plus, there has to be something else that's a minus. Don't want to go into great detail, but an example would be in the balance sheet, let's say that business pays off a bill. Well, what happens is the bank goes down, current assets goes down by that figure, but so does short-term liabilities because the bill's no longer owing. So really the balance sheet stays in balance. The crucial bit is to understand that to make the assets and the liabilities bigger, i.e. to increase what's going to get owed to the shareholders, you have to have retained profit. It's the only way that those figures can get bigger. They can move around all the time. So, you know, double entry is going on all the time. You're paying bills, people are paying you, your vehicle's, you know, depreciating and stuff like that. All of those figures can change around day by day, and in the balance sheet, they'll be different tomorrow than they are today. But the total at the bottom is only going to change by making profit and leaving it in the business. So the thing to realize is the accounting software does most of that for you. But the big question is, how much do you leave in the business? If you basically take out too much, then what will happen is that equity in reserves will be on the other side, which basically means you, if the business wound up, you'd owe the business money back to make it solvent. So it's quite an important figure, but there is a balancing act, as I said before. You know, do you want a large amount of equity in reserves, which is obviously going to make your assets look great compared to your liabilities, or do you need that, and could you actually not take some of that out? And that's a decision to be made with a professional advisor, I think, because it's a personal choice, but it also depends on what figures you're leaving. So a couple of thoughts on balance sheet. First thing to realise is the assets are in there at cost. So when you buy a property, it goes in the accounts at cost and it usually stays at cost. So when you look at your balance sheet and go, oh, it's not looking that great, it may well be that the property or some of the assets are worth different than they are in the accounts. It's not common to have the freehold stated at value. You can, but it's not very common for that to happen. And the assets, the vans and the equipment will obviously be depreciated, so the accountant will be reducing the value, but there's no guarantee that's the real value. So you might look at your fixed assets and go, oh, it says I've got 80 grand. That could be a lot higher if there's a freehold going up in value. It could be a lot lower if those assets aren't depreciated well enough. So fixed assets are often not valued properly. The rest of the accounts are usually okay. And for that reason, the accounts may be inaccurate. The director's loan account is in there, and this is where we get a problem with directors and shareholders. The equity bit on that previous slide is the shareholders, but in the accounts under assets or liabilities is money owing to or from the director, called a director's loan account. When I go through accounts, I like to add equity to the director's loan because they're really the same thing. They're only split because in large businesses, the two people aren't the same. So you need to realise that if your balance sheet's looking good, it's only looking good because there's a 200 grand asset called a director's loan. That really means the director owes 200 grand to the business. But the reality is that probably isn't going to happen. It's probably going to have to get written off somehow as dividends at some point. So banks will often look at that and go, well, we'll discount that because that's not money that's going to come in. Similarly, if you're looking at the accounts and go, oh, some of these figures aren't looking good, if the liability is money owing to you as a director, that's only going to be a problem if you actually intend taking it out short term. So be aware that director's loan account and equity are really the same thing. They're your money, plus or minus. The other thing I found in accounts balance sheet, the stock and work in progress is an asset because you could sell the stock. The work in progress is money you're going to bill in the future. But they're not always stated properly because nobody explains to business owners how to work that out. And again, that often only happens at the end of the year. So come the end of the year, we make big adjustments because the work in progress and stock in the bookkeeping is the same as last year's. Nobody's changed it. In reality, if you're running your business and you have stock of work in progress of any significant amount, that ought to be valued monthly and adjusted in your books monthly so you know what your profit is. And deferred tax, you may see in the balance sheet, that's really, without going into great details, that's a future tax bill that may crop up. which the accountant has to provide for, but it's not imminent. It's going to be well over a year or many years ahead. So that's some thoughts on the balance sheet. So let's just look at an example. So we've got assets on the right. As I said, fixed assets would be vans and freeholder. Current assets would be money in the bank deposit, money owing, which we call receivables. And under the liabilities, long term is a bank loan. Short term are some payables to suppliers. There's some VAT, tax and PAYE bills. There's an overdraft of 50,000. And actually, there's quite a bit of retained profit in there. So the business owner has put in £100 to buy the shares, and they've basically left in 268,000, and they've also got a £9,900 director's loan, which is, I think that's equity. So first thing to look at is those figures. As I said before, that is basically the difference between your assets and the liability. So the bigger the figure that is, if it was your personal life, obviously the more your house is worth compared to your mortgage, the more you've got in your current account compared to your credit card, the better. But in a business, the business obviously transforms into personal life when you draw money out. So there's a balancing act to do as to how big that figure is. And some of the figures we're going to look at may influence that, because if the equity is negligible, then that may well put banks off. So we'll go through a few key numbers. These aren't obvious numbers, but hopefully I'll explain them in a way you can work them out. So current ratio is basically the comparison between short-term assets, current assets, and current liabilities. And it really measures over a year how much more can you pay off your debt with what's going to come into your bank. So that's on there. That's basically everything that's in current assets. So that's current liabilities on the right in red, and current assets on the left, which is the positives. And if you basically look at those figures, we've got current assets of 134, we've got current liabilities of 120. So the ratio, the relationship is that current assets are 1.12 times current liabilities. And a key number is 1. So that means you've got enough coming in on the left within 12 months to pay what's got to go out on the right in 12 months. But banks would look at that figure needing to be between 1 and 2. So 1.5, you can pay your bills off 1.5 times over, is about where it needs to be. So if I had one number to measure in a business, that would be the only number I would pick first, because it's a very great guide as to whether you're going to be able to see your way through the next 12 months. And that for most businesses is the most important sign of all. Sales growth, great, but you might not be getting paid quickly. You know, profit might be great, but we don't know whether it's in the bank. So there are other numbers, but I say if we had to pick one, that's the one to do, which basically means I'm saying that has to be in your armory. The other thing to be aware of there is we've got £24,000 worth of receivables. That's money owing from customers. Again, we sometimes find that that might include stuff from 2 or 3 years ago that just hasn't been written off. So is that figure real? Because if that figure is really only going to generate 14, then obviously our current ratio will be a bit lower. And that's the first thing banks will ask is, you know, what's in there, how long has it been owing, and is it actually collectible? Another measurement, which is a variation on that, which banks will look at, is called the quick ratio. And it's basically looking at the same thing. So they still take the current liabilities, bills and things that you have to pay within 12 months, but they're only going to look at, on the positive side, they're only going to take receivables, money owing from customers, and money in the bank. They're going to ignore stock and work in progress. They're going to ignore any other current assets. And that's called a quick ratio because that's a good indication of how you can pay your bills off over 3 months. It's not that accurate, but that's the sort of aim. And obviously the banks will allow that to be a lower figure, but they're really looking for that to be between 0.6 and 1. So if the left-hand side isn't 0.6 or above, then the bank might see that as an issue, and so should you. In this particular business case, it's 0.23. So although the current ratio was just about where we wanted it, the quick ratio isn't. And what that indicates really is that the immediate cash we're going to get from customers and the money in the bank is the stuff that's going to come in soon. We've got an awful lot of stock and work in progress, and banks ignore that because when they're closing down a business, they're basically only interested in immediately grabbable money. which is receivables and money that's already in the bank. They're not going to go to the trouble of selling your stock on the open market. They're not going to go to the trouble of finishing your work in progress. So in this case, that is a problem, 0.23. And the main reason it's a problem compared to current ratio is we've got an awful lot of stock. So the question in that case would be, how can we get that figure better? We need to convert more of that stock and work in progress into cash quickly and keep that figure low. So that might be inefficiencies in terms of billing or finishing jobs. It might just be we've got stock that's lying around we don't need, or we might just be ordering it too quickly. Most businesses these days can order stock, pretty much immediately. So that's two important numbers, and I think those two are numbers that you have to have in your armory. The other one is debt to equity. So that's basically debt, which is any money owing to HP, loans, banks, compared to what is in equity. And the reason that's important is the same as it is in private life. Is basically if you put down a 10% deposit on a house and the mortgage company puts in 90%, then they're putting in 9 times as much as you. And the banks want to know that in a business. They're basically going, how much are you invested in the business compared to how much you want us to be? Because we're not going to put in all of it. We're not going to take all the risk. And obviously they're going to take less risk than mortgage companies because they often won't have any security. So basically what they want in those particular cases is they want a ratio of about 2.5 to 1. So every pound you put in, they're prepared to put 2.5. So measure that, because if that number's higher than 2.5, then the banks may be looking at that and going, we're too exposed. There may be other factors going on, but it's certainly a figure to know. In this particular business case, it's 3.75. So the banks could look at that and go, yeah, it's not working out. We've got too much in. And that's another reason why you wouldn't necessarily want to take all the equity out for your personal use, because that then is no longer invested in the business. So the bank are basically more supporting the business than you are. So try and keep to that sort of figure, 2.5. The other thing to point out from the balance sheet, which is the way I've laid it out, is basically you can see that the long-term stuff is at the top of both columns and the short-term stuff is at the bottom of both columns. And it's useful to look at how those two things match up, because we've got basically freehold property of 200,000, probably worth more now, and we've got vans of 20,000. They're long-term assets, but we've actually only got a long-term bank loan of 40, and we've got an overdraft which is short-term of 110. So we've probably borrowed the wrong type of money to buy those assets. In an ideal world, golden rule is you should basically borrow the same sort of time frame debt that fits what you're using it for. So if you're borrowing because you've got customers owing you, there is short-term factoring and stuff you can do to relieve that. If you're buying stock, you can usually get stock finance, which is short-term. But if you're buying a freehold, you can get a 25-year mortgage. If you're buying assets, you can usually get a 5-year HP. So generally look at your balance sheet and see whether those match up. One way or the other, you may have too much long-term. But again, the key is not to finance 5-year term assets with overdrafts, because you're financing an asset that's going to last 5 years with an overdraft that could be repayable within 1. So mismatching is quite a common thing, and it certainly is the case with this example company. So what they might want to do in this case is go to the bank or a mortgage company and just say, look, we've got a property worth at least 200,000. Can we take out a mortgage, which means we don't have to pay so much in the short term. We're not as much at risk of having to repay the overdraft and the Batman and the taxman. And that would be perfectly acceptable in this case. Other measurements are debt coverage. Won't go into that in great detail, but debt coverage just says by how much does your profit, usually the EBITDA version, compare to your 1-year debt repayments. And that needs to be about 1.25. So you need to have 1.25 profit compared to basically your debt repayments. Higher would be better. And that's basically saying that we can cover what we need to pay out to debt with our profit that we expect to get. Retained profit I've already talked about, so that's quite important, but there is a balancing act. Mismatched debt we've talked about, and return on investment just basically says, compared to what you've left in the business, what's the profit as a percentage? And that really says you've invested in the business, so what are you getting back for that money? Because if it's, let's say, 2%, the chances are you could wind the business up, put it into the stock market and get more money than you're getting at the moment. So the two things you're getting a reward on are labour, your labour. So are you getting the right return for your labour? That's the owner wage adjustment we talked about. And are you still making a profit? And is that profit then in line with the amount of money you've had to leave in the business to support it? And that means you're getting rewarded properly in both areas, the work you do and the money you've invested. There is a business cycle, which I won't go through in great detail, but if anybody wants to go through this, it just illustrates how a business cycle works, going through from the initial injection of money to how it works. And basically it's a spin cycle. Once you've generated money from profit, businesses that grow reinvest. They don't just draw it out. That can be slightly risky in COVID times, but generally it's a bit like the property millionaire. What they don't do is invest 100% of a property to buy it and then wait until they've actually got enough rent to buy another property 100%. They borrow 90. So they're highly geared, and once that property makes money, they then use the 10% for the next deposit. Riskier, as I say, to go through that cycle, but in non-risky times, the quicker you can move your money around that cycle, the more successful you're going to be. So that's balance sheet. I say there are a few other numbers in there that I won't go through because there isn't time, but I'll go through a few things at the end that you can access that will help that. But hopefully that's just shed a bit of light on an area that's not well known. So quickly just look at protecting assets. This should be fairly straightforward, but I thought I'd include it. So limited liability companies obviously protect the business owners to a large extent, not completely, but it does mean that if your business fails, except in some rare cases, then it's only the company's assets that are at risk. Holding company, that means you can basically have your company owned by another company, which you also own, and you can sort of move the cash and the assets into that holding company. So if anything did happen to your trading company, you don't lose the whole thing. You've still got the cash protected, you've still got the assets protected, and you could theoretically start again. That's quite possible. Different businesses need that, especially post-COVID, and not everybody does. But that's something to think about, whether you want to start keeping some of the assets and the juicy stuff somewhere else. Security for loans provided, that's obviously looking at when you lend money or whatever, see if you can get security, but also review the security you're given. It's quite common for lenders to ask for directors' guarantees. That really removes the whole limited liability stuff, and don't always have to do that. Review the terms of trade, so make sure that the terms you've got with your customers and your suppliers fit, because they're rarely reviewed. Check you've got all the right insurances, so make sure you've got business interruption insurance, indemnity insurance, and cover for everything that could possibly happen in your business that's adverse. And obviously financial planning, so personal wealth outside the business as well as the business, and plan for the future. So that's things like wills, power of attorney, make sure there's no big inheritance tax bill and stuff like that. So this goes on the back end of business planning. So best practice, I think, is to basically have the 3 essential business tools. So that's annual business plan. So that's a generic plan, not financials. That's just what are we going to try and do, what products are we going to do, what products are we going to stop, who are we going to sell to, how are we going to sell to them, where are we going to sell to them from, etc. That's the plan. And then you have an annual forecast, and that's basically the money side of things following on from your business plan. My personal view is that if you're running a business, unless it's what I call a job business, where it's a one-man band and they're really just doing a job, but they're calling it a business. So that's a one-man band taxi driver or one-man band plumber. Every other business needs to be doing business plan and forecast, in my view. It's essential. And then obviously ongoing reporting and accountability. And I would look at something more than just the annual accounts that accountants do. some form of monthly figures, which could come from internal as long as they're reasonably accurate, or they could be formal. We'll show you how we can do that a bit later. But knowing your numbers is just the beginning of the whole business success cycle, but an essential part of it, hopefully you'll agree. So next steps is, as with all of these webinars, is just do something. Have 3 things listed on your notes to say this is what we're going to have to do. If you basically take in the knowledge from this, I can guarantee nothing changes at your business end until you take action. So just learning from it will make you more aware and more informed, but it won't actually change anything until you put something into practice. So get started, start calculating your numbers, compare that to your plan on a regular basis, compare it to your industry and your targets, and doing nothing, as it says there, is not an option with numbers. So how can we help? Well, it's what we do regularly for clients. So there's a number of ways. These are just a few I thought might fit in. We have got a workshop that we do for a business one-to-one, but as many of the people in the business can come, and that's similar to what we've done today, but we actually come up with 5-year set of figures for a make-believe business, and then we get everybody to basically look at it and see how they think it's doing. Then we go through all these key numbers that we've discussed today and a few others, and we throw a few highlights on what's going on internally, and then we reappraise that business and see if we understand it a lot better. So it's almost like looking at your own figures, but by using a dummy set. And that's really useful. That's like a morning, and as many people as you want can attend that, because pretty much everybody in the organisation needs to understand those figures, and that's £250. We've got business plan and forecasting, we obviously do, and that varies depending on how much of it you're going to do. Benchmarking we do for free. Often we'll do that at year-end meetings, but if we don't, or you're not a client and you want benchmarking, we can benchmark your figures for free and tell you how you're doing compared to your competitors. And that benchmarking is not like the ones you get in the post. This is small businesses. So if you're a corner shop, we aren't comparing you with Tesco's, but we are comparing you with sole traders as well. Management reporting, that's basically, we don't call it bookkeeping because it's basically getting the right figures from bookkeeping. And we do that for many clients quarterly or monthly, depending on when they need it. And that can be all of it, or it can just be just finishing the stuff off where we do the depreciation and the tax and the accruals and prepayments and work in progress to get them accurate, so you can then look at the numbers knowing they're the real numbers. And a complimentary meeting, if you want a meeting just to go through what this means for you, the stuff we've talked about today, then you simply book up a meeting, we'll get that slotted in. Clients already have a complimentary client review, so we can use it for that. So there's a few things there. If you want any of those, just simply put it in the Q&A or just email me, which for those of you who don't know is support@marklawson, marklawson.co.uk, and we'll help out wherever we can. So questions and answers, just got a few minutes on that because I know I ran over as I said I would do. So just see if there's any in there, we can quickly go through a couple. Yeah, there's only one in there at the moment, that's good. So yeah, what is the difference between annual accounts and management accounts? Management accounts are, as expected by the name, they're figures produced for the management. So somebody in the organisation produces figures, usually on a monthly basis, but it can be more frequent, and they're presented to the board so the board can understand how the business is going. And that board meeting to go through the figures is a crucial part of running a business. But they're often not the final figures that an accountant would do, although if you get them done by an accountant, they will be proper management figures as if they were the year-end. Year-end figures have all the bells and whistles, most of which is not relevant to you, but I say the key things are work in progress stock. They have to be in there to make the figures accurate. If your stock's gone up by 100 grand and you don't change it until the end of the year, that's 11 months worth of figures that are going to be 100 grand out. You know, so it can be a big difference. So management accounts are basically what comes off your bookkeeping system, but there are certain tweakings that I think ought to be done to make them understandable and relevant. End of year figures are produced really for the taxman and Companies House, and it's the management figures that are really the juicy bits of information. The annual accounts are a necessity, but they're slow usually, not with us, but with a lot of accountants, and therefore not really looked at by business owners, but there needs to be something instead. So hopefully that answers that. No other questions, but if there is anything else, I say just email me. But hopefully you found that a bit more of a useful insight into accounts and knowing your numbers. If there is anything else, just get in contact. And if you need any of those services, also let us know. And remember to just download the 2 reports there. There's a bit more information in that and the slides just to reflect on what we talked about. So thank you for attending, and to say hopefully we'll see you at the next session, which will be sometime in June. You'll get invites. I haven't even decided on the subject matter yet, but if there is any subject matter you like or haven't seen yet, put that into the questions, and we'll try and put those in at some point in the future, but probably towards back end of June will be our next one. And as with all of these, they are recorded, so if you want to allow the team to go through this, or you want to go through it a bit more leisurely, then within a couple of weeks it will be up on our YouTube site. So hopefully take care, wish you all the success in your businesses, and hopefully speak to you, even if it's through a webinar, next month. Thank you.